All right, so we're going to spend a little bit of time now on a case study, and it's talking about the optimal retirement structure. Now, you'll notice in these three scenarios, each client has total assets worth $7.5 million. Now, even if you don't think your assets will get to that level, that's fine. Many of these concepts still remain the same, even if your assets at retirement are 2 million or 3 million or what have you. What we're really looking at is the differences from a cost, income, and tax perspective, both now and in the future, across these three different scenarios. Scenario three, this is a client who owns their own primary residence for $1.5 million, and then they really are property people. So they've got $6 million in a range of different investment properties, all owned in their personal name. Scenario three, so this is one where the clients may really like investing in property, which is fine, but they haven't paid much attention to their superannuation. So commonly it could be, say, business owners who were never employees. And the problem with this structure is not so much the properties, because you could have property in a self-managed super fund. It's actually that the properties are all owned personally. So from an income perspective now, there's $6 million in investable assets. So it actually produces quite a high income yield of $240,000 per year. The issue is that it's a very bad tax outcome. So if this generates $240,000 in income, this couple could pay $60,000 a year in tax, which is massive when you compare it to this $3,000 a year in scenario one. So this could be $1.2 million over 20 years compared to $60,000 in the other example. So it's just such a bad tax outcome by not being planned early enough. It's also a bad cost outcome because properties do have a lot of ongoing costs. So things like rates, land tax, which has obviously gotten bigger recently with some of the changes from the Victorian government, and tenant costs that pop up as well. Now, in terms of the future, these properties could be kept. However, it's likely that beneficiaries would sell them, as all that income being added to the taxable income of beneficiaries who are likely still working if they're adult children would create more tax issues for them. And it's also hard from an estate planning equitability perspective to split properties because they all have different asset values. So if you've got multiple kids, how do you actually structure it in a way that you're fair to each child? That's a really hard part. Whereas with, say, your superannuation balance, you can just split it evenly. Now, we know primary residence is unlikely to have tax when sold in the first 2 years, and the investment properties are illiquid, so they're likely to trigger considerable capital gains tax when they're sold, which is another bad tax outcome in the future. And we know the costs in the future are also considerable with those different property costs.